Greetings everyone. I'm your facilitator Rajat Kush and I'll be covering introduction to swap contracts in this training. So these are the learning outcomes for this training: introduction to swap, introduction to currency swap, introduction to interest rate swap. I have divided the full training into two modules. In this particular module, we'll be covering these two topics, and in the second module, we'll be talking about interest rate swaps. So let's start. So a swap is an agreement between two parties. What is this agreement saying? That they have agreed to trade cash flows over a certain period of time in future. Two of the most popular swap contracts are currency swap and interest rate swap. In a currency swap, two parties exchange the cash payments in different currencies, and in future they keep on exchanging interest on these currencies. In the interest rate swap, there is exchange of only interest rate in future. There is no exchange of any currency in the day zero of the agreement. So agreement defines the dates when the cash flows are to be paid and by and the way in which they are to be calculated. For example, in IRS interest rate swap, there is a notional amount on which the interest rates is calculated. This notional amount is never exchanged between the two parties. Usually the calculation of cash flows involve future value of interest rate, an exchange rate, or other market variable. We are going to cover them in detail later. A forward contract, if you have gone through this training or if you already know about forward contract, it is similar to your swap contract where you are exchanging cash flow only once. When valuing swaps, we require a risk-free discount rate for cash flows. Globally, this risk-free rate has been LIBOR. Some important pointers: financial institutions like yours are prepared to enter into a swap without having an offsetting swap as well. This is pretty common for the banks. If one of the companies default, the companies with which you have entered the swap contract, if they default, still you have to honor the agreement with another company. In general, a LIBOR-based floating rate cash flow on a swap payment date is calculated based on this, which is principal multiplied by rate multiplied by your number of days since the last payment divided by 360. Fixed rate, on the other hand, is usually quoted as actual by 365 or 30 by 360. What is a confirmation? A confirmation is a legal agreement underlying a swap contract, and it is signed by the representatives of the two parties who are entering into this swap contract. The drafting of this confirmation has been facilitated by ISDA, which is based out of New York. This organization has produced number of master agreements that consist of clauses defining some details regarding terminologies which are used in the swap contracts, what happens in the event of a default by either side, and so on. Master agreements also cover all outstanding transactions between two parties. The full confirmation might state that the provisions of the ISDA master agreement apply. This is a replica of your confirmation, right? So your confirmation will have a trade date, on which date you actually traded this swap, effective date, from which date the swap becomes effective, which business day convention you are going to follow, which holiday calendar this swap contract is going to follow, what will be the termination date of this contract, and some parameters regarding fixed amount payment and floating amount payment. Okay, so this is a replica of your IRS. Now let's talk about currency swap. So in a cross-currency swap, cash flow in one currency are exchanged on regular date for cash flow in another currency. I'll give you an example in detail. As of now, just understand some basic definition. We are exchanging one currency with another currency, and this is going to happen for many months or many quarters. The principal amount are normally exchanged at the spot foreign exchange rate. Okay, so let's say A is supposed to deliver dollars in future, B is supposed to deliver pounds in future. They're also going to exchange these currencies at the start of the contract as well, at the exchange rate which is applicable on that particular date. And when this swap will end, they are going to re-exchange the same currencies which they had delivered earlier. Now they're going to receive it back at the same exchange rate, not at the exchange rate of that time, right? This exchange rate at which they initially exchange the currencies. The interest payments can be calculated on a fixed rate or a floating rate basis. So let's look at the example of a cross-currency swap. Let's say Etisalat wants to expand in United States and IBM wants to open operations in UAE. Now, if both of these companies, Etisalat and IBM, come to you asking for a loan, good chances you are going to give lower interest rate to Etisalat. And why is that? Big brand name, local company. But if both of these companies go to, let's say, JP Morgan or any US bank, that US bank is going to offer lower interest rate to IBM. Why? Because big brand, they are domestic company. But the problem here is if Etisalat takes a loan from you in dirhams and then they go into US and they start operating there, their revenues are going to come to them in the form of dollars, but they still have to make you payment in dirhams because the loan is in dirham. IBM is going to face the same problem if they borrow money in dollars. So what these two companies are going to do, Etisalat is going to take a dirham loan and they are going to pass it on to IBM. IBM is going to take a loan on dollars and they are going to pass it on to Etisalat. And going forward, since Etisalat will be working in US, they will be generating their revenue in dollars and they will be making interest payment to IBM in dollars. Okay. Similarly, IBM will be generating revenue in dirhams and they will be making interest payments to Etisalat in dirhams. And Etisalat will pass on this interest rate to your bank. And similarly here, IBM, when they have received interest from Etisalat, they are going to pass it on to their bank. I have explained you this in a very layman way, but when we are going to cover IRS, you're going to understand that two parties usually do not come together. They usually involve a middleman, a swap dealer, which most of the time is a bank. And this swap dealer is going to handle the exchange of payments between the two companies. So this is your cross-currency swap. So question is, principal amount is not exchanged in cross-currency swap, true or false? The answer is false. Because I mentioned initially, your notional amount is not exchanged in IRS, right? But your notional amount, there is no notional amount as such. In a cross currency, we do exchange money at the start of the contract as well, right? Right. So in IRS, notional, in currency, no notional, we have to exchange the currency. So a swap contract is an agreement between two parties called counterparties to trade cash flows over a period of time. Interest rate swap allows company to borrow at fixed rate and then exchange it with floating rate. For some reason, they are not able to borrow at floating rate. In cross currency, cash flow in one currency are exchanged on a regular date for cash flow in another currency. Notional or principal is not exchanged in IRS, but it is exchanged in the currency swap, both at the initiation of the contract and at the end or maturity of the contract. So thanks for attending this training. Hope to see you in the second module.